You know that moment when you open your banking app and see it? $50,000 sitting there? And instead of doing a victory lap, you're nervous. Because now it's not just, can I survive? It's, what if I make the wrong move and mess up years of grinding? Look, if you've stacked 50 grand, you're not behind, you're not broken, and you're not bad with money. You've already done the hardest part. You built margin. But this is exactly where the money rules stop being about hustle and start being about placement. Here's what we're gonna do. First, we'll lock down what portion of that 50,000 should stay boring and untouchable. Then we'll decide what portion should start working harder than you do. And finally, we'll set up a simple system so you're not reliving this debate every month. And just so this hits home, if your 50,000 sits in a regular checking account earning basically nothing, inflation quietly takes bites out of it every single year. At 4%, $50,000 earns about $2,000 a year, basically a free month of groceries from the bank. Now zoom out one notch. 50,000 is the line where cash stops being just an emergency blanket and starts being a tool you assign jobs to. Most people miss that shift, and it's why they either hoard cash forever or they jump into risky stuff way too fast. The new game is simple. Keep enough cash so you don't panic, then invest the rest in a way that's boring on purpose. The biggest myth at 50,000 is that you're supposed to feel safe now. Reality is, you're safer than you were, but you're also exposed to a new kind of risk. The risk of doing nothing and letting time pass. If you're 25 to 45, time is still your unfair advantage. A single decade of consistent investing can do more than a decade of coupon clipping. Let's talk about the first job your money needs to have. Your sleep at night fund. This isn't a random rule like always keep 6 months. It's a scorecard based on your actual life. If your job is stable, you've got low fixed bills, and you can replace your income quickly, 3 months of expenses in cash might be enough. If your income varies, you're self-employed, you have a mortgage or kids, or layoffs are common, and you may want 6 months. Common mistake right here. People hit 50,000 and keep stacking cash like they're still in crisis mode, even when they've got a stable job and zero debt. That feels responsible, but it's actually a sneaky form of fear, because cash is the easiest thing to understand. Better approach is to decide your cash target once, park it somewhere that pays you, and then give every extra dollar a different job. This week, list your essential monthly expenses, then multiply by 3 and by 6 to choose a cash target that matches your risk. Here's what that cash target looks like with real numbers. If your essentials are $4,000 a month, 3 months is $12,000, and 6 months is $24,000. So when someone says, keep 6 months, you can translate it into an actual dollar line in the sand instead of a vague vibe. Once you've got that target, the next job is protecting yourself from fake emergencies. The stuff that's not a crisis but still derails you. Car tires, holidays, a surprise plane ticket, a medical deductible, a slow month and a side hustle. That stuff happens every year, like clockwork. You keep a small buffer for those, maybe 1 or 2,000 depending on your life, and now your true emergency fund stays untouched. When you separate those two buckets, you stop raiding your savings every time life gets mildly annoying. Cool, now the money that isn't protecting you gets a different assignment. Growth. Here's another common mistake. People treat investing like a personality test. They wait until they feel confident, which usually means they wait until prices are high and headlines are calm. A better move is to make the decision when you're calm and automate it so your emotions don't get a vote. This is where the money order matters, because at 50,000, you're finally big enough that tiny efficiency wins are worth real dollars. If your employer offers a retirement match and you're not taking it, you're leaving free money on the table, sometimes 3%, sometimes 6%, depending on the plan. If your company matches, say, 5% and you make 100,000, that's 5,000 a year you either take or you hand back. Over a decade, that's 50,000 of free contributions, and that's before any growth on top. If you're already getting the match, the next obvious win is using any tax-advantaged account you qualify for, because taxes are basically a silent fee on your future. And if you've got a high-deductible health plan and an HSA is available, that account can be a weird little superpower when you treat it like a long-term investment bucket. Now, I'm not going to pretend everyone can max everything. Most people can't, and that's fine. But once you've got 50,000 saved, you've proven you can build a surplus, and surplus is what buys you options. So the question becomes, how do you turn surplus into momentum instead of just a bigger pile of cash? Think about your savings like an engine. Cash is the oil that keeps it from blowing up, but investments are the horsepower that actually moves you forward. If it's all oil and no horsepower, you're safe but stuck. If it's all horsepower and no oil, you're fast until you crash. The balance is the whole game. Alright, here's the practical filter that makes decisions easier. If you've got high-interest debt, your best return isn't the stock market, it's killing that interest rate. Paying off a credit card charging 20% is like earning 20% guaranteed after tax. That's hard to beat. If you don't have high-interest debt, the decision is mostly about timeline. Money you might need in the next 1 to 3 years should usually stay in cash or short-term, low-risk stuff. Money you won't touch for 5 years or more can afford volatility, which is a fancy way of saying it can handle being ugly sometimes. So if your emergency fund target is, say, $15,000 and your buffer for predictable stuff is $2,000, that's $17,000 staying liquid. On $50,000, that leaves $33,000 available to do more. And yes, keeping extra cash feels comforting, but comfort has a price tag. If that extra $33,000 sits in cash earning 4%, that's about $1,300 a year. If it's invested and it averages 7%, over the long run, that's closer to $2,300 a year. That gap seems small in a single year, but stacked across 10 years, it's the difference between nice and meaningful. Some people hear that and go, okay, so I'll dump all $33,000 into the market tomorrow. Then the market drops and they swear off investing forever. Instead, you can ease into it without being timid. You can move a chunk in now, then automate monthly buys for the next 6 to 12 months. That's not market timing, it's emotion management. It keeps you from making the dumb move later too. This week, set up an automatic transfer from checking to your investment account on payday, even if it's just $100, so investing becomes a default instead of a debate. Now here's the part that really messes with people at $50,000, the first big lifestyle purchase after you hit it. A nicer car, a bigger place, the we deserve it vacation. And look, you might deserve it, I'm not your parent. But the trap is turning $50,000 into zero and calling it a milestone. A clean rule that keeps you sane is to separate your long-term pile from your wants. If you want a $10,000 upgrade, build a $10,000 sinking fund for it on purpose over time. When you pay cash from a sinking fund, you get the thing and you keep your investing plan intact. When you pay from your core savings, you're basically borrowing from your future self at compounding interest. Here's a quick way to feel that cost. $10,000 invested for 15 years at about 7% grows to roughly $27,000. So that $10,000 treat isn't $10,000, it's closer to a missed $17,000 in future dollars. That doesn't mean never buy anything fun, it just means you should know what you're trading. And yeah, life's messy and markets don't hand you 7% on a schedule. Now let's talk about what changes inside your head when you cross 50,000, because that's the real battleground. Up to 10,000, every extra 500 feels like a win you can see. At 50,000, you can save 500 and barely feel it because the pile's bigger. So you start craving drama, you start looking for the one move that makes you feel like you're doing something. That's when people start day trading, chasing crypto hype, or moving everything into one hot stock. Most of the time, that's not confidence, it's boredom mixed with anxiety. The better approach is boring consistency with a few smart levers that matter. A huge lever is your savings rate, not your stock picks. If you make $80,000 after tax and you invest 10%, that's $8,000 a year. If you raise that to 20%, that's $16,000 a year, and you just doubled your speed without needing a miracle return. Another lever is your income, because you can only cut so much before life starts feeling miserable. An extra $5,000 a year invested is powerful. An extra $10,000 a year is a timeline changer. And the lever that nobody brags about is staying invested when it feels gross. If you invest consistently through a down year, you're buying more shares at lower prices. That's how compounding gets its teeth. Quick pause. If this breakdown is helping your money path feel clearer, hit subscribe. I make calm, honest, deep dives like this every week. While we're here, don't underestimate one clean career move. If you can raise your take-home by 10% and keep your spending mostly the same, you can redirect thousands a year into investments without feeling it. On a $70,000 take-home, a 10% bump is $7,000 a year. Invest $7,000 a year for 15 years at 7%, and you're looking at roughly $170,000 to $200,000, all by itself. Sometimes that bump comes from switching companies. Sometimes it's a raise with receipts. Sometimes it's a skill that your market actually pays for. So what does a realistic path look like from $50,000 to something that actually feels like freedom? Let's run a simple example. Say you've got $50,000 today. You keep $17,000 in cash for safety and buffers, and you invest $33,000. Then you add $1,000 a month, every month into a simple diversified portfolio. If that portfolio averages around 7% over the long run, in 10 years you're sitting around $200,000 to $250,000 depending on the ride. That's not a fantasy. That's math plus time plus behavior. And once you've got a couple $100,000, the growth starts showing up even if you're not doing anything heroic. 7% on $200,000 is $14,000 in a year. That's bigger than a lot of people's annual contributions when they started. This is why people say the first chunk is the hardest, not because you're weak, but because your money hasn't started helping yet. Now, I want to give you a quick scorecard you can use without overthinking it. If your cash is less than 1 month of expenses, you're still in fragility mode, even if the total looks big. If your cash is 3 to 6 months and your high-interest debt is gone, you're in stability mode. If you're investing at least 15% of your take-home and your income's trending up, you're in builder mode. If you're investing 20% or more and you're not blowing up your lifestyle with every raise, you're in accelerator mode. The labels don't matter. What matters is knowing what lever to pull next. Here's the leak most people ignore: lifestyle creep that hides in subscriptions and nice-to-haves. It's not always the big purchase that gets you, it's the slow monthly stuff that becomes invisible. 5 subscriptions at $15 each is $75 a month. That's $900 a year. Invested for 20 years at 7%, $900 a year turns into roughly $37,000. Again, you don't need to live like a monk. You just want your spending to be conscious, not automatic. This week, open your last 2 months of bank statements and cancel or downgrade one recurring expense you don't actually care about, then send that exact amount into your investments every month. Now, let's zoom into the moment the rules really flip, when your savings starts throwing off meaningful returns by itself. At $50,000 invested, a good year at 7% is $3,500 of growth. At $100,000 invested, it's $7,000. At $250,000, it's $17,500. At $500,000, it's $35,000. That's why the middle feels weird. Your effort stays the same, but the results start accelerating. So the goal at $50,000 isn't to become a finance genius. It's to avoid the handful of mistakes that reset you to zero. The first reset mistake is buying a payment you can't unwind, like a car that eats $600 a month for 6 years. A $600 payment isn't $600. It's $7,200 a year, and it crowds out investing fast. Another reset mistake is using your savings as permission to take on a bigger mortgage than you can comfortably handle. People see the down payment and forget the monthly burn rate. If your housing costs jump by $1,000 a month, that's $12,000 a year you now have to cover forever. And the reset mistake that hurts the most is panic selling when headlines scream and your account's down. If you sell after a drop and buy back after the recovery, you lock in the loss and miss the rebound. You don't need perfect timing, you just need to stay in the game. Alright, let me show you a before and after timeline that makes this obvious. 2 friends, same age, same income, both hit $50,000 in savings. Friend A keeps it all in a big bank savings account, earning 1% and tells himself he'll invest later. Friend B keeps a solid emergency fund, invests the rest, and adds $500 a month. After 10 years, friend A's $50,000 becomes about $55,000, maybe $60,000 if rates change, but it doesn't really run. Friend B's invested chunk plus contributions can be north of $150,000, sometimes closer to $200,000 depending on returns. That gap isn't intelligence. It's a system that runs even when you're tired. And here's what happens next. Once friend B hits that zone, the growth starts funding future goals, house projects, career breaks, maybe early retirement options. Friend A still feels like every goal requires starting over. So when you're sitting at $50,000 and you feel stuck, that feeling is normal. It's the moment you graduate from saving money to managing a balance sheet. Your balance sheet has a safe side and a growth side, and you want both. If you're wondering what to invest in, keep it simple. Broad, low-cost index funds are boring for a reason. Boring is reliable. Reliable is what gets you rich slowly, which is how most millionaires actually do it. And if you're still thinking, yeah, but what if the market crashes right after I invest? Then you buy more with your monthly contributions, and you thank your past self for keeping an emergency fund so you don't have to sell. This is where that cash target pays for itself. It turns volatility into noise. One more quick math moment because it changes how you see procrastination. If you invest $1,000 a month for 20 years at 7